So on this channel, we focus on the San Diego real estate market and what's happening right now, what's potentially going to happen in the next few months, what's happened in the previous few months. And it's super important, especially if you're looking to buy or sell a home, in the relative near future. But it's also good to have a bird's eye view and zoom out and see what's going on and have that long-term vision of buying a home right here in San Diego. But today we're going to dive into the long-term value of home ownership right here in San Diego through the eyes of a home buyer in 1995. So let's get into it right now. So in 1995, the median price of a home in the United States was about $130,000. A little bit more obviously here in San Diego, where you're getting 160 to 190, somewhere in that range. The average 30-year fixed rate mortgage was sitting just above 8.5%. And the housing market was steady, but it wasn't crazy. We weren't seeing, what we saw in the extreme rise over these past few years, but we also weren't seeing a market crash like we did in this 2008 timeframe. So that home buyer in 1995, now we're sitting in 2025, which is 30 years later. So we're assuming in that 30 years, assuming they had a 30-year fixed rate mortgage, that mortgage is now paid off. Also, the assumption that if they did refi, it didn't change off their payoff date. Now, during this time, we saw a huge rise in home prices in the early 2000s. We saw the big crash shortly thereafter. Homeowner went through the Great Recession, went through the lockdowns of 2020, and then the boom that we saw shortly thereafter. Yet despite all of that, all the ups, all the downs, that 1995 homebuyer is probably still more than content with the decision they made in 1995. So number one, US home prices rose 300% between March 1995 and March 2025. Here's the chart looking at the 30-year change in statewide home prices. Some are a little bit lower, some are right around that 300. And then if you look over to California, it was well above that. California home prices rose over 400% during that time. So you're even better off if you bought a home in California in 1995 till now. Now, if you bought a home in 2025 here in San Diego, are you assuming that you are staying in it till 2055? Most likely not. Some people do stay that long, but even during those times, if you sold at different times and bought another residence during that time, so you've been a homeowner for those 30 years, you're probably still well off. So from this article from Resi Club, when you tell this to someone, they might push back that the S&P 500 rose 926% during that same March 1995 to March 2025 window. However, to accurately do that comparison, there are three things to consider. Number one being leverage here. Most home buyers purchase with leverage, meaning their initial investment is usually the down payment, not the full value of a home. So if you're purchasing a home right here in San Diego, you're likely not putting down the full amount unless you're buying cash, obviously. So a lot of people who are purchasing homes right here are putting a certain percentage down, and the rest the bank is going to give to you, your lender is going to give to you. So you're actually only coming to the table with 5, 10, 20%, whatever the case may be. In some cases, let's say you bought an $850,000 house. We're working with some clients right now who are VA buyers. Their actual down payment was $0 because that is part of the VA program. And we were able to negotiate credits as far as a rate buy down for them and some credits as far as concessions to pay some closing costs. So they are getting into a house for very little money for closing costs. Now, most people are putting, like I said, it's not that traditional 20% really anymore. Some people do 20%. If you're selling your current home, you're going into the next home, it could be more than that 20% if you just want to roll over that equity, or you can do other program where it's maybe 5 or 10%. It really comes down to your situation and what you're looking at. So be aware that it's not that standard 20%. I mean, it can be if you want to avoid property mortgage insurance, PMI, then usually it's that 20%. And if you're putting less down, yeah, it's going to increase your monthly payment a little bit. But either way, in all these cases, you are using leverage. Next up is opportunity cost. While it's tempting to say someone could have invested the S&P 500 instead, in reality, that same person might have needed to use a hefty chunk of that money to pay rent, which likely rose over time if they hadn't bought. So a lot of people who are renting, you do still have that monthly payment, right? You don't necessarily just take, okay, I'm not buying a house, so I get to take all that money that I was going to put into a house and I get to invest all that into the stock market. Now, these days, renting here in San Diego is likely going to be more expensive than purchasing homes. So it's not like back in 1995, it was a little bit different story when your rent, if you were going to rent a home versus buying a home, it was either on par or even potentially a little bit less. Nowadays, depending on how much money you put down, that might not be the case, but it still comes down to putting your money somewhere and potentially putting that into your own property as opposed to, paying somebody else's rent or stuffing it all into the stock market. And the third is utility. Homes aren't just investments. They provide shelter, stability, and access to certain school districts. Obviously, stocks don't do that. You just put it in there. You get to bring it up on your Robinhood app or whatever. You get to check it every day. But I think that's one of the biggest overlooked things when people are considering potentially investing in a home or doing other things is the utility that you get from the home. You get to raise your family in it. It's somewhere to sleep. It's somewhere to kick back and watch Netflix. It's somewhere to enjoy your morning coffee. And you get to enjoy that over the span of those 30 years as well. So I think utility is probably one of the biggest things in purchasing a home that a lot of people maybe think about, but obviously don't take into account when running the numbers. And now just because home prices rose, let's bring it back to California, 401% from March 1995 until March of 2025, it doesn't necessarily mean that it's going to do that from 2025 to 2055 because each housing cycle is different depending on taxes, right now tariffs, depending on what's happened in the political climate, depending on what's happening in your specific neck of the woods, whether it be insurance costs. There's just a lot of moving parts, but the long-term data does reinforce one critical fact, and that is that homeownership has historically been an effective vehicle to build and preserve long-term wealth. Number two benefit is hedging against inflation. And this is how a fixed rate mortgage eases housing cost pressure. Here's our 30-year shift from March 1995 to March 2025. U.S. consumer prices rose 111%. U.S. weekly earnings was 152%. U.S. rents 176%, where U.S. home prices rose 300%, and U.S. total personal income rose 312%. Next up in this article, one of the quiet superpowers of a 30-year fixed rate mortgage is greater payment stability. Now, it can't contain home insurance, property taxes, or maintenance costs, or HOA, those kind of things. So those could potentially go up over time. But by containing the principal and interest components, which are big pieces of your mortgage, now in the early parts of your mortgage, those first 7 to 10 years, a lot of that payment is actually interest payment. So you're paying a little bit of principal and a lot of interest. Now, as you go through time, you start paying off more principal and less interest. And then towards the latter part of the loan, it's a little bit of interest and a lot of principal. That's why having a long-term view of home ownership is better off for your financial situation. If you're thinking about buying a home and you're like, I might be there, let's say you're relocating for a job and you get relocated every few years, you're like, I might be there 2 or 3 years. There's a little bit more risk than if you are planning on being here 10, 15, 20 years, because during that time, let's say there is a little bit of a correction. Well, you don't have that longer term time horizon to make up the lost amount, and you will be potentially selling at a loss. So once you start focusing on, these 10-year chunks, you're going to be a little bit better off if you're planning on being in a home for that 10-year period, 8, 10, 15 years, whatever it might be. You're going to have a little bit more of a safety net than that short-term view. And so fighting inflation, let's just take this example. Typical home buyer in March 1995 locked in a monthly principal and interest payment of around $900 based on a 10% down payment, a 30-year fix of 8.53%. Now we'll get into the refinance that it mentions there in a little bit, but in the years that followed, U.S. personal income grew 312% and weekly worker earnings rose 152% between March 1995 and March 2025. Over time, that fixed rate mortgage payment consumed a shrinking share of many 1995 homebuyers' incomes. What may have been a financial stretch in the 90s became far more manageable by the 2000s and eventually a bargain. Meanwhile, renters faced steadily rising housing costs, with U.S. rent inflation climbing 176% between the same time frame. In contrast, long-term home owners saw their housing expenses remain relatively stable. Now, what do they mean relatively stable? Yeah, you have the principal and interest that are locked in. The insurance, especially now, could be a big piece that is changing, that could potentially be a bit more expensive if you bought even 5 years ago compared to today. I know insurance companies are raising rates. They are potentially dropping people. There's less options out there, which is adding to the cost. So that could be something. Even where I live right now, HOA fees, when I moved in, it's probably gone up by about 50 to 75% from when I did move in. You will see that over time as well, especially as you get into older HOAs. But beyond all that, it still makes sense because that's one reason home ownership tends to create financial breathing room over time is locking in the principal and interest, basically locking in your rent for the next 30 years, which is a large portion of your housing costs. Now, like they said too, there's other things to take into account: maintenance, water heaters go out, remodeling, all that kind of stuff. But it's still putting that money into your own property as opposed to putting it into your landlord's pocket. Now, the third benefit is refinance opportunities along the way. The average 30-year fixed mortgage rate during the first week of March, I think this is supposed to say 1995 right here, was 8.53%. The March 1995 mortgage borrower had plenty of opportunities to refinance in environments where the market rate was at least 100 basis points or 1 percentage point lower than their initial rate. Highlighting three of them: in the early 2000s, rate dipped below 7%. Post-2008 financial crisis, rates fell under 5%. In COVID era lows, historic sub 3% rates in 2020 and 2021. Hence, that's when a lot of the housing boom right here in San Diego did happen. That's when there was that frenzied market that we did see here as far as purchasing home. But a lot of the lenders we work with too, they were getting a ton of refinances. I refied my property a few times during this time as well. You were just seeing it a lot of times because if you get in a interest rate below that 3%, I mean, that's probably won't see that for a very long time. Now, had the 1995 mortgage borrower refinance even once to say 6.5% from that 8.5% in the early 2000s, they could have shaved tens of thousands of dollars off their total interest payment and possibly shortened their loan. Now you're like, most people refi, they're going to go back into that 30-year fixed rate mortgage because that's going to be the lowest payments. And a lot of people are just thinking about that payment amount, especially even when you are purchasing a home. A lot of times you're just thinking about the payment, your monthly payment, not as opposed to the price. Let's say you refied 10 years in, you had 20 years left on your original loan, you refied at a 30-year, well, that resets the entire loan. So there is, you do refi, you do get a lower rate, but if you lengthen the time, a lot of that's going to be eaten up by the interest payment that you do have. And you have to go through the whole process again. It's not just like people think refi, throw out that a lot. It's super easy. You have to go through the whole process, talk with the lender, get an appraisal, all that kind of stuff. So it's a full another thing as well, but it does make sense in certain situations, especially if you were able to, like it says here, refi into a 15 or 20-year loan as opposed to that 30-year loan where it made sense financially, where your payment was potentially even less during that time, depending on what the rate was. So you could still stay on that original timeline. And then they make a really good point here, especially anybody watching this. Don't think that you're going to purchase right now, and which people were saying, I know agents were saying this a few years ago, marry the house, date the rate. Horrible saying. You need to get into a property when you're purchasing a property where you're comfortable with what you're at right now for the foreseeable future. So just because 1995 home buyers had several opportunities to refinance, it doesn't guarantee future home buyers will. Let's say rates you purchase right now, you're on the border of where you're comfortable paying for your monthly payment, and you're like, okay, well, we'll refi next year. It's gonna be a better situation. Rates are gonna be lower. Let's say something happens, rates go up, and then the next year they go up, or they even stay the same. And then you were banking on them going down, and you're stretching your limits as far as your comfort level and your monthly output into your house. Well, at that point, you can be in trouble. Let's say at the same time, because when you get an appraisal or when you get a refi, you're going to have to get an appraisal. Well, what if the market's changed a little bit and the home price has gone down a little bit? Well, at that point, you're only going to refi up to that amount. There's going to be potentially having to come up with the extra amount. So there's a lot of moving parts in there. So don't bank on refining if you can potentially refi. Like we had clients bought last year and the rates were a bit higher. They were able to refi this year and actually shave some money off of their monthly payment. Now, if you can refi, it's definitely a benefit, but don't go in with the mindset of, I'm just going to refi. Go in with the mindset of, I'm good with this payment for the next 30 years, which is the length of the loan usually. Because right here, no one can predict mortgage rates with 100% certainty. There's no shortage of forecast models for both home prices and mortgage rates, and no shortage of those models get it wrong. Past outcomes do not guarantee future results, and uncertainty is a constant factor when it comes to mortgage rates and home prices. The past few years have only underscored this reality. Now, the fourth part of the story, riding out the storm, the 2006 to 2011 bust. A lot of times we refer to it as the 2008 housing bust, but as you can see right here, it did start a little bit before that. 2006 is when prices did start going down. I saw a little dip, come back up, and then going down again. You can see California is one of these lines in here, but just go with the US total as a whole. Kind of peaked up in this 2006 going into 2007, and then saw a drop going all the way down, and some places didn't recover for a long time. So why is this part in the article? They're not saying it's going to happen, but just to give you some perspective on that long-term thinking as well. So the elephant in the room is that most Americans who hitched onto the homeownership wagon in 1995 had to ride out one of the worst housing market downturns in U.S. history. Between July 2006 and January 2012, U.S. home prices, as measured by Freddie Mac Home Price Index, fell a staggering 28% peak to trough. In places like Phoenix, Vegas, certain other areas, this was up to 50% drop. Homeowners who had purchased in the mid-90s found themselves facing a sharp decline in their value of their properties, with many watching as a big chunk of their home equity evaporated. It took until February 2017, a long time, if we look back up here, before it got back to this mark. So we're going across right here. So it took a long time going from the 2006, 2007, 2008 until home prices did recover, in some places 2017. It took until February 2017 for US home prices to retake their bubble peak from July 2006. For those who purchased homes in 1995, this represented a significant waiting period requiring patience, resilience, and the ability to weather the financial and emotional toll of the downturn. And I like how they put in the emotional part too, especially even right now, if you're looking at the stock market, if you're looking at a lot of stuff, I mean, the stock market's recovered, but anytime you see that go down, the wealth effect of, even if you're not planning on cashing that, you're like, well, my account said I had $100,000 and now it says I have $82,000. It's $82,000 on paper that you don't have, but you know, unless you're planning on selling it at that point, and honestly, it doesn't really matter. It's just a paper loss at that point. Just like if you invested 50,000, now it's up to 100, that 50,000 just a paper gain until you do, you know, decide to sell it. But looking at it, just having that mental, like, oh shoot, it did go down, but I'm all right. I'm still good. Not planning on selling. We have a long-term view of this whole thing, which that's why I'm trying to get you guys to have a long-term view on the home buying process. And then it goes on to say, however, those who held on through the storm emerged with a lasting reward. The dramatic price growth of the past decade has more than made up for the early losses, and many have recouped their losses and more. The housing market, like any investment, moves in cycles. While national home price crashes are rare, local market corrections are not uncommon. Even right now here in San Diego, we're seeing some areas that are flattening out a little bit, where we're not seeing those insane, you know, going up 5, 10, 15%. They're kind of flattening out. So a lot of areas are seeing month on month flatness, or a little bit down or a little bit up, as opposed to bigger moves. Still, the potential for long-term wealth accumulation is often realized by those who can weather slumps and lulls and stay invested for the long haul. So the big picture, as we look ahead to the next 30 years, it's possible to predict exactly how the markets will evolve, but the core principles remain. Ownership is both shelter, like we mentioned, and an asset, both cost and opportunity. For many households, it continues to serve as one of the most accessible and reliable paths to long-term financial security. In a housing world often dominated by short-term headlines, the story of the 1995 homebuyer reminds us why zooming out can be so powerful. It's not just about what housing is doing this month, it's about what it can do over a lifetime.